Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard. John, welcome back to Kaiser Watch.
Jim, pleasure to be back on the show.
John, how did the Kaiser Favorites do in August?
Well, the KRO Favorites 2022 index, which consists of 8 juniors, was up almost 33% in April, but then it all went downhill, bottoming down 21.2% in mid-July, after which it almost got even in early August as we had that general rebound in the market. But the past few weeks it's been terrible. It's now down almost 20%. Except for Verde Agritech, which is still up about 150%, the others are down 20 to 63% for the year, except for FPX Nickel, which is only down 10%. In big picture terms, the culprit is the general concern that the persistent inflation that we've witnessed, a belated response by the Federal Reserve, now turning into whatever it takes type of attitude, keep increasing these interest rates until inflation starts to go down. Today we got the employment situation report, another 310,000 jobs added during August. Not really what everybody expected, given all the cooling down of things. Inflation in July was actually zero on a month-over-month basis, but that was really only due to oil prices retreating that month. Other things like you go to a restaurant, you go to the store, everything is costing more, and the metal markets they've sold off. And in the case of gold, we have a situation where the market thinks that the Federal Reserve will be quite effective in crushing the economic uptrend and delivering a recession, a hard landing, which will cause prices to come down, everything to become subdued, and that's not going to be particularly helpful for gold, which has been trending down. And people who are studying what's going on in China has its own slowdown problem, part of it self-induced through its zero COVID policy, but now the drought is also causing big energy problems for them, and the supply chain problems that we keep hearing about, they are persisting. And if the Taiwan and China situation turns into a hot conflict between China and the United States, which it almost has to because the semiconductor industry that the world relies on is still concentrated in Taiwan, if that happens and more sanctions, economic sanctions between China and the United States emerge, inflation is going to end up even higher because it'll be caused by scarcity of goods. And as long as everybody's focused on this idea that inflation has to be brought down by crushing the economy, by having people become unemployed, there is this expectation that demand for raw materials, copper and whatnot, it is going to go down. So the market, as the metal prices have undergone a preemptive decline, and of course with this expectation that higher interest rates will put pressure on the real estate market, perhaps cause a cascading decline in real estate as interest rates adjust to higher level and people can't afford to make their payments anymore. Everybody is having this deja vu experience, so there's a risk-off attitude, and the juniors have been pretty much roadkill during this period. We always hope for a September rally. It is the sort of the end of August, even though we're already a couple of days into September. Usually there's this expectation that after Labor Day, when people get back to work, things will tick up. But given this backdrop of expecting interest rates to keep going up, and next week we get the inflation numbers, find out what happened in August, I'm not so sure that we will be getting a meaningful September rally, at least not one that will be broad-based. On the plus side, the resource junior listings on the venture exchange, they have now had the longest streak of dominating traded value since that 2009-2011 period when they dominated. Since then, they've only had a few two or 3 month period where the traded value of resource listings was higher than that of the the non-resource listings. But now we've had 8 straight months with only a few days of the non-resource listings trading more in a single day. And the total traded value for the resource juniors, while it's back to the levels of first quarter of 2020 before COVID really took off, it is still several times above the lows achieved in 2015, where traded value of resource listings was down to around $10 million a day. It's still running around $30 million a day, plus or minus $5 million. But what's really shocking to see is how interest in non-resource listings has completely evaporated. And a question for a fall rally will be, will there be an interest in the resource juniors as opposed to the other issues that are more related to the general economy? Can't tell. It's going to be a very interesting final quarter for 2022.
Verde Agritech at the moment is your only KRO favorite winner this year. How do you think it will finish the year?
Well, if you look at the market action during the past week, you would think that it's going to be a pretty miserable finish. One of the big concerns in the past month has been plant to commissioning. The window July through October is the big selling shipping window, and if your 1.2 million tons per annum capacity is not up and running during that period, and obviously it hasn't been during the first 2 months, you're not going to meet your guidance of selling almost 700,000 tons of K-Forte to the Brazilian farmers during the second half of 2022 as they've guided. So the market has been very uneasy. On August 31st, they did declare that we have now commissioned and we are ramping up production. So they've got at least 2 full important months of filling trucks with K-Forte and delivering it to the farmers. But you would have expected the stock to rally, but it hasn't really done that. The next milestone, of course, will be confirmation. Do you have the orders to match the new production capacity that you now have in place? And that remains to be seen. Also, there is the price of potassium chloride. It has trended down. It's still well above the level that they're using for their revenue and profit projections. But the market's now switched into a glass half empty mode with regard to Verde Agritech. They won't be reporting any results until mid to late November. And so we have several months of uncertainty. There is the question of whether they will get their NASDAQ listing that they supposedly have applied for, and if new audiences will discover the stock. So it's good that they are commissioned and now producing. The other thing that's sort of hanging over the market is the election battle between Lula and Bolsonaro, which takes place election takes place in October. It is now hitting a fever pitch, and while it makes no difference which party ends up in charge of Brazil for Verde Agritech's business strategy, there is the concern that if Bolsonaro should lose, since he has now adopted the stance of the Republican Party that any victory that isn't ours has to be the result of a stolen election, and therefore a justification for violence and so on. Bolsonaro has pretty much predicted that if he doesn't win, it is because of a stolen, rigged election. And Brazil isn't really structured for that sort of outcome, but it doesn't matter when it's all about power and you have this meme going that if you lose, it's not because you actually did lose, it's because it was stolen. If he puts out a call for physical violence with either directly or implicitly, like a certain other loser has done, and we start seeing violence erupt in Brazil, that will scare off investors. And while the bigger companies and entities probably won't be really affected, a smaller junior that's just an emerging junior, which has a fairly substantial retail shareholder base, it will be vulnerable to perceptions that maybe Brazil will become destabilized as a result of this upcoming election. It's difficult to predict what will happen over the next 3-4 months. And hopefully the little pullback we're seeing in Verde Agritech is just a bit of a late August, late summer market jitters. And hopefully everything gets back on track in September. But the underlying story remains strong. This is more about perception rather than fundamentals at the moment.
Why is FPX Nickel down only 10% compared to the others?
Well, the price of nickel, which went to the moon earlier this year because of a short squeeze, it's retreated back to $9.30 or so per pound, which is still well above the $7.75 base case price they used in their PEA, and nickel's still holding up, reasonably well compared to, say, copper, which has retreated from its $4.50 to $5 range down to about $3.50. But the advantage FPX Nickel has is that nickel is linked to the electric vehicle sector as a key component of a cathode for the higher quality batteries that are in cars like Teslas, the kind that the sort of people who are willing to buy an electric vehicle now, they don't want some lithium iron phosphate battery with a short driving distances. That's fine for a place like China where people are being mandated to switch to electric vehicles. But here in, say, the United States where you have choice, it's it's a trickle-down effect of the economic pyramid. The ones at the top are going to be the first adopters of an EV because they can afford it, but they're going to insist on having a quality car, not something that's a simple replacement for a car that gets you from point A to B. Now, the thing with nickel is that much of the production of nickel has shifted to Southeast Asia with Indonesia and the Philippines dominating. This is all laterite nickel. It is produced in the form of a ferronickel, nickel pig iron. That can be fed directly into the stainless steel mills. Some of it's upgraded higher and with extra processing can be turned into battery-grade nickel sulfate, which is what you need for these lithium-ion batteries. But all these laterite operations, or at least most of them, have very large carbon footprints. So insofar as the whole electric vehicle transition is about shifting away from fossil fuel combustion and carbon loading of the atmosphere, these laterite nickel are not a good source. The LME warehouse stocks, which is where the refined nickel ends up, that comes from sulfide concentrates that have been mined at places like Russia's Norilsk or Sudbury or Voisey's Bay. They get sent as a concentrate to a smelter and smelted into a 99.8% or better grade. And this is what is generally used to make battery grade nickel sulfate for the industry. And the LME stocks are actually quite low. They're about as low as they were in 2008. However, the LME and Shanghai warehouse stocks aren't that meaningful anymore because now the lateritic sourced nickel just doesn't go into the warehouses. It goes directly from the producers to the end users for use in stainless steel. So FPX Nickel's Dakar project would make a ferronickel product that can also be fed directly into a stainless steel mill. But what's coming up is a scoping study in September that explains the economics of bolting on an hydromet unit to convert the ferronickel, which is 65% nickel and the rest of it is iron, into a battery-grade nickel sulfate. So we're waiting to hear about that. And then in the final quarter of the year, they will have a hydromet plant producing this material, both to demonstrate it, the process, and also to provide material to ship to the battery makers, because the devil is in whatever impurities remain. So they will want to see what this flow sheet they've developed, what the nickel sulfate looks like. And so this last quarter of the year is going to be very pivotal for FPX Nickel, because that project has the capacity for having a very low carbon footprint. It might even achieve carbon neutrality, and this could be something that the Teslas, the Volkswagens, all these groups that want a secure supply of nickel with a low carbon footprint. This is the next stage for FPX Nickel, and it's the CAR project. And I think it's the fact that there has been skepticism about the whole flow sheet in general, and this low-grade deposit has kept the stock from achieving, like it should be, based on all the numbers, should be a 2 to 250 stock. So it's already started the year undervalued, and it's stayed undervalued. But with this linkage to the whole energy transition, in particular the EV explosion that's expected by 2030, especially now helped with California's decision to ban fossil fuel car sales, new car sales in 2035, that's going to attract interest in FPX Nickel, and that's of the favorites. That's one that I think is right now, with its price where it is, I think that's definitely one that one should bottom fish for right now, regardless of what you think is going to happen with the general, recession outlook or inflation outlook.
Is there any common theme that explains the poor performance of your other favorites?
Well, Jim, it seems to be exposure to copper and or gold. The worst performer is Mark O'Day's Northwest Copper Corp, which is working on an economic study that combines mill feed from the higher grade underground ore at the Stardust project, which is a skarns, polymetallic skarn system dominated by copper, and combining it with the lower grade Quanica ore, which is copper gold. The original portion will be a lower grade open pitable feed, and then the deeper block caving source will have a stronger gold credit into it. And poor Northwest Copper is not getting any love in the market, and I can only imagine that it's linked to the fact that copper has dropped to current price range of $3.50, and something similar is affecting poor P2 Gold, which hopes to have a PEA out for its Gabs Copper Gold project by the end of this year, and this project all depends. We talked about it last week. It really depends on what sort of mining plan you develop and how you optimize your flow sheet or your ore schedule. And at this stage, it's almost a gold project, because they plan to spend the first 4 or 5 years mining the gold-dominant oxides near surface with a heap leach operation that postpones the heavy capex spending to farther down the road. And so they hope that the market at least hopes, I think internally they think it will, that market hopes that this will allow them to clear all the development hurdles, even given the current gold and copper prices that we have right now. But the other thing is, with regard to copper, I think these stocks that have a dominant copper focus, these are also ones one should be a contrarian bottom fisher. When you look at the LME combined Shanghai warehouse stocks for copper, and all the copper, pretty much all the copper flows through these warehouses, those levels are down to where they were in 2007, while the China super cycle was getting underway. And the global economy is much bigger than it was then, and in turn its demand for copper. Plus, we have copper as a key part of the energy transition, and in particular as a part of the electric vehicle, all that wiring that's in there. So there seems to be a disconnect between the pricing in the copper market, the warehouse stocks that we're seeing right now, the minimal copper development projects in the pipeline, and the expectation that if the energy transition is real, there will need to be a lot more future copper supply. So I think the weakness in copper juniors like Northwest Copper and P2 Gold, I think this again is a temporary thing, and I wouldn't be surprised to see them rally, because what we're starting to see, even in California, we saw Gavin Newsom, look at the Diablo Canyon, the last sort of nuclear power plant in California, and they were supposed to pull the plug on this, and they're looking at the energy shortages, especially now that we've got a heat wave going here where the air conditioners are all cranking and they're worried about brownouts, and say, well, why should we pull the plug on this? At least the nuclear energy is clean and is clean energy. And so now that they've made this decision to, I think the car makers have already made the decision that they're going to switch, but now that at the government level these decisions are being made, now we shift from just yapping about needing to shift away from fossil fuel combustion. Now we need to look, okay, how are we actually going to do that? So the pencils are going to come out. They're going to be sharpened. They say, where's your lithium coming from? Where's the copper coming from? When are you going to build upgrade the grid so that you can actually deliver this? What's going to be the energy input? Maybe we need some more nuclear. So I think copper gets caught up in that. Gold, however, doesn't. So if you've got a gold component with your copper story, and it's critical to it right now, there's a big pall hanging over the whole perception of gold in the future.
How have your gold-focused favorites done?
Well, they have not done very well. I mean, Perpetua Gold Corp, if you look at the feasibility study numbers and you look at where the price of gold is even today relative to what it was in the feasibility study assumptions, this stock should be trading substantially higher. However, it seems to be trapped in this perpetual permitting treadmill, and it's suffering from that expectation I described earlier that the Federal Reserve will be successful in subduing inflation. However, they will not reverse the accumulated effect of inflation. These higher costs that emerged as a result of the last couple of years of supply chain disruptions, these are not going to go away. So now we have this nasty scenario where CapEx and OpEx are increasing for projects like Stibnite, but we have the expectation that inflation will end up back to a low level, and the U.S. dollar will remain strong as everybody treats it as a safe haven to flee to. And so we will not see the gold price going through $2,000 in real terms, and that will harm the economics of projects such as Stibnite if and when they ever get permitted. So the gold's weakness, I mean, it even traded below $1,700 this week. That's a big problem for the gold-focused favorites. And crypto, despite looking like a train wreck that's just waiting to happen, I mean, when you hear about all these energy shortages coming, when you look at Europe, the Russians are turning off natural gas supply to Germany so that it has to shut down its production capacity. It's Russia's way of fighting back against the sanctions. Can you imagine allowing crypto mining to still waste electricity in Europe? And where's it going to shift to? Well, Russia is going to have a lot of gas. It's not shipping anywhere. So Russia's going to become this great crypto mining kingdom to help undermine Western democracy in favor of thuggish autocracy. So when you look at the whole future of crypto in this manner, I suspect that it's going to have a rough time as not only countries ban crypto mining as a way to save electricity, but also it ends up shifting to countries that are perceived as fundamentally hostile to democracy. And that may cause a wake-up call amongst these people out there and say, why will crypto continue to go up in value and allow me to claw away wealth from others who are willing to, buy this crypto crap from me and give me some real money so I can buy real things. I think we're going to see an implosion of that, and that might restore interest in gold as a long-term hedge against uncertainty. But for the meantime, stocks with major ounces in the ground focus, they're going to suffer because there's no expectation out there that the price of gold is going to develop an uptrend anytime soon unless they truly lose control of the inflation situation. But interest rates, when you can jack them up to 20%, that's a powerful way to subdue inflation.
How are your discovery-focused favorites doing?
Well, Orion Resources and SK Mining are down 60% and 40% respectively. But these are exploration companies, and they could turn around regardless of what the price of gold is doing or what other metals are doing. Orion is now drilling its 100% owned Risti project in Finland. The market's not really giving it any anticipatory premium for success. They've been on this project for 5 years. They've been chasing these high-grade gold boulders, but because of this till in the area, it's really difficult to map the surface bedrock and see where all the structures are. So they've adopted a till sampling strategy, which was what enabled Rupert to make the basically a blind discovery at Ikkari, which is 5 million ounce discovery. It sits on the border with the a project, joint venture to Roma project of B2 Gold and Orion. They've been drilling the Hemi discovery earlier this year, and Orion's been putting up 25%. They've reported interesting results, but none of them that we've seen so far are on the same scale and intensity as the Ikkari results. So the market's sort of assuming they still haven't found a repeat of Ikkari on their 10-kilometer segment of that structure, which hosts that system. So now the attention shifts to the Risti drilling. They have now generated targets based on basal till sampling. Hopefully we will learn something new, but with the drilling just getting started this summer, it'll be late fall before we hear anything. So that stock will languish. But again, Dave Lotan has been busy buying stock in the market for his own account, and he has been doing deals to tie up these underlying royalties on very, very good terms for Orion. So I'm fairly optimistic about Orion making a comeback later this year. They have plenty of money to continue with both their 100% project and their SIP 2575 JV with B2 Gold. So again, this is like early bottom fishing season for a junior like Orion. Now in the case of SK Mining, they've got 4 rigs turning at the SK project in the Golden Triangle. They're focused on 2 main target areas, the TV Jeff, and I myself don't have any great optimism that the TV Jeff will deliver anything earth-shattering this year. But the Scarlet Valley area, which is basically almost virgin territory, had a few holes in the past that they're targeting. It's not clear what those holes were targeted at, but they're seeing a very powerful VMS setting. They're no longer talking about silver sulfosalts and stuff like that, but they are talking about sulfide replacement mineralization, and we need to see assays for the drilling that's coming up there. And the stock has suffered somewhat because it started off the year with a $400 million valuation premised on SK Creek 2 being delivered, and of course that would take the $3 stock up to the $20 level, but they don't yet have that whole 109, and until we see that, the stock's going to have a rough time getting any upside. And they've got 3/4 of their 30,000 meter drill program going. Hopefully assay turnaround will be faster this year than last year. But one of the things that's probably also hanging over the market is that some of their shareholder base may be cannibalized by Quinton Henney's arm waving about Snowline Gold's new intrusion-related gold system discovery in the Yukon at its road project. And there you have, rather than high-grade, short intervals within a complex VMS setting, here you have broad intervals of very consistent gold mineralization. They reported one hole that even after you stripped out the high-grade intervals, the 2.3 gram per ton interval of several hundred meters, it dropped to only 2.1 grams per ton. So we're looking at a bulk tonnage scenario. And Quinton Henney can do its basic 3D math multiplied by the specific gravity and show here's the tonnage footprint, here's the sort of grade we're getting, and it's a new discovery, and it could be a significant bulk tonnage, tens of millions of ounces system. And Quinton Henney is also a big supporter of SK Mining's project. But when you contrast the small, short, high-grade intervals they get at SK, which you can't translate into tens of millions of ounces that are bulk mineable, with what they're seeing at Snowline, you have a scenario where people say, okay, SK still has a $300 million valuation. Snowline's at $450 million. They have lots of holes still to come for the rest of the year, and we can do the numbers, and it has a better chance of going to $1 billion valuation based on what we're already seeing than SK Mining has at the current situation, where we can only hope that some of these intervals with long intersections of sulfide replacement mineralization do deliver a combination of gold silver that allows us to start saying, aha, now we also have a very, very big discovery in this place. So I suspect that the stock is being cannibalized by shareholders, switching, selling off this stock, figuring they can always buy that back later, and putting it into other stories such as Snowline Gold, which is an emerging gold discovery.
John, what sort of juniors are you going to be focused on after Labor Day?
Last week I talked about Lithium Mania 2.0, and I'm going to be putting a lot more attention on the lithium-focused companies, not so much the ones that are doing lithium brine type operations in the lithium triangle, but more the ones that are drilling pegmatite systems that are lithium enriched. And we have the example of Patriot battery metals. They have broad intersections of very good grade. You can see the tonnage footprints. It's sort of a similar scenario to the Snowline Gold, where you have this intrusion-rated gold system and very broad, consistent mineralization. You're seeing the same thing in the area of these pegmatites, not these sort of skinny dike-like ones that some of the juniors have intersected. Those are not very interesting. In fact, it was kind of embarrassing how another newsletter writer was going on and on about some 6%, 1.15 meter interval. Like, who cares? These projects are going to be bulk tonnage, mineable systems. If you got 1% or better lithium oxide, and there's no impurities like iron in it, you're dealing at $30 a pound lithium carbonate. You're dealing at $2,000 rock, and you're still dealing with sort of a $800, $900 rock if lithium retreats back to the $10 a pound range. And with the California mandating zero ICE car sales by 2035, everybody has to look really hard as to where is the lithium going to come from. So while nickel may not be part of the popular battery configuration that drives that underpins the sales of cars that ordinary people end up buying, lithium definitely will be part of it. So I can see a big boom that's going to last several years. And again, you have this longer-term scenario of lithium, which was an $18 billion market last year, becoming a potential $100 billion plus market. That puts it on the par with the gold production, and which is about $100 billion a year. So when you get these high-value intervals in these deposits that nobody has ever cared about, that are not skinny little squirrely veins in the Abitibi Greenstone Belt, but they're these 50, 100 meter wide pegmatite bodies that can be 10, 20, 50 million, even more tons of ore running this. That's where you're going to see a lot of interest, and not every one of them, for local reasons, will end up being suitable for development. But when you have lots of these all coming together, the car sector and their battery maker suppliers, they're going to love it, because they're going to see their future supply problem being solved by all this exploration in places like Eastern Canada. But the other thing I'm focusing on are just plain emerging discoveries. Because when the market's worried about metal prices and economic trends and all that, anything where the price of the metal, of your target metal, is relevant, that has a hard time attracting speculative interest. But if you are drilling a target and that target starts to take shape as a high-grade discovery whose size and ultimate grade are open-ended until you've delineated it, that creates its own little bubble world. And coming up next week on Friday, September 9th, I'll be doing my presentation at the Metals Investor Forum. There'll be 5 companies there in my session that I all regard as emerging discoveries. This is different from drilling interesting targets and hoping that they hit something. They've already had the edges of what appear to be major discoveries. So these types of companies, I will also be looking for those. Obviously, when bottom fishing season comes in the last couple of months of the years, I'll be looking for the groups that are doing generating these targets and are in decent financial shape and are competent management groups. But during the September-October period, I'm going to be looking at companies with emerging discoveries that could end up capturing the market's imagination and creating their own little speculative world that is immune to what the interest rates are doing or what the gold price is doing. And by the way, with lithium carbonate, it has stuck up there at $30 a pound. It has not dropped like everything else. Rare earths have come down substantially this year from the first quarter. But the lithium carbonate, I suspect there's stockpiling going on. Companies are buying it and putting it aside because they see a supply shortage, an imbalance between the demand from all these EVs being built and what's able to come out of the ground or the salars, and that's what's keeping that price up. And even if it comes down, it doesn't matter. The price right now is so high that it's not sustainable to allow EV fleets to replace ICE cars, where ordinary people at the lower end of the economic spectrum end up with an electric vehicle. The lithium carbonate at $30 a pound is just way too high. So the lithium mania sort of pegmatite exploration plays are also in this emerging discovery category. Those will be easier to spot when they emerge. The other ones, you have to look hard to recognize that this little intersection that a company reported, like last week, Canalaska reported 9 meters of 2.4% uranium. By itself, it doesn't mean much, but in the geological context, if you're paying attention, that can mean a lot. And because we are in a glass half empty market right now, where people only take seriously the 100 meters of 10-gram gold type of an intersection, such as Fruta del Norte or Beryllium back in 2006, this is a great market to be looking closely at results that come in, and then just following the threads to see if this is the beginning of something very significant that could blossom into a self-sustaining, emerging discovery play.
John, thank you so much for the update.
You're welcome, Jim.
We've been talking with John Kaiser. I'm Jim Goddard. Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.